The International Monetary Fund expresses its concerns over Kenya's decision to cap bank interest rates. Egypt's Minister of Supply resigns amid the highest profile corruption case since President Abdel Fattah al-Sisi came to power in 2014. Plus, South African President Jacob Zuma says he's backing Finance Minister Pravin Gordhan but cannot intervene in a police investigation. Hello and welcome. This is Business Incorporated coming to you live from Lagos. I'm Chimezie Obi Iwawu. The International Monetary Fund says Kenya's decision to put a ceiling on the amount of interest banks can charge their borrowers may exclude small borrowers from accessing loans and further curb already sluggish private sector credit growth. Armand Morales, the International Monetary Fund's representative in Kenya, said small firms and individuals could be deemed too risky by banks whose lending rate will be capped at 400 basis points above the central bank rate, now at 10.5%. According to him, narrowing the spread will make it less attractive for banks to continue lending to them at the same pace. Meanwhile, shares of Kenya's biggest lenders fell to multi-year lows on Thursday, and the central bank was forced to sell dollars to keep the exchange rate stable after the president signed a law capping commercial interest rates. And in Egypt, the Minister of Supply, Khaled Kanafi, has resigned amid the highest profile corruption case since President Abdel Fattah al-Sisi came to power in 2014. Hanafi's resignation is the most senior-level fallout from a probe into whether millions of dollars intended to subsidize farmers were used to purchase wheat that did not exist. Egypt, the world's largest importer of wheat, has been mired in controversy over whether much of the roughly 5 million tons of grain the government said it procured in this year's harvest exists only on paper, the result of local suppliers falsifying receipts to boost government payments. If Egypt's local wheat procurement figures were misrepresented, it may have to spend more on foreign wheat purchases to meet local demand, even as it faces a dollar shortage that has sapped its ability to import. I'm moving on now to Asia. Japan's consumer prices dropped for the 5th consecutive month in July, adding to pressure on the government to expand its already massive stimulus program. The data was worse than estimates had suggested and marked the biggest annual drop in more than 3 years. The core consumer price index, which excludes volatile fresh food prices, fell 0.5% compared with a year earlier. Tokyo has been trying to raise inflation for years to stimulate spending and boost the economy. The disappointing data comes on the heels of weaker than expected economic growth released earlier this month and despite an aggressive spending policy by the government. Asian markets closed mostly lower on Friday, with Japanese stocks selling off more than 1% after soft inflation data prompted concerns over the effectiveness of government stimulus. The benchmark Nikkei 225 closed down 1.18% across the Korean Strait. The Kospi declined 0.27%. In Hong Kong, the Hang Seng Index bucked the downward trade to climb 0.33% in the afternoon trade. And in Australia, the ASX 200 slipped 0.48%. Chinese mainland markets, the Shanghai Composite closed near flat at 3,070.47, while the Shenzhen Composite added 0.20%. And Iran's oil minister says that Tehran will cooperate with the Organization of the Petroleum Exporting Countries to stabilize the world oil market, but expects others to respect its rights. Meanwhile, oil prices fell on Friday after the Saudi energy minister tempered expectations of strong market intervention by producers during talks next month, and as analysts pointed to an ongoing supply overhang that was weighing on markets. International benchmark Brent crude oil prices were trading at $49.40 per barrel in early trade, down 27 cents from their previous close. Our U.S. West Texas Intermediate crude was down 15 cents at $47.18 a barrel. With the start of the trial of suspended President Dilma Rousseff in Brazil, economies are monitoring the markets closely for any financial impact the judicial processes may have. One says the fallout has yet to play out, but Brazil's economy should be able to ultimately weather the storm. The lengthy impeachment process has paralyzed the politics of Latin America's largest nation and is expected to culminate in her removal from office next week.
Financial adjustment has yet to be made. We have the proposal for changes to the budget, which will be a very important vote for the government at the end of this year or beginning of the next year. With the success of that vote, we are going to really put the country back on the right course. In other words, we're avoiding the worst in economic terms with the question of impeachment. But still, it's not guaranteed that the country is on a good course. We're in the middle of the road, well, in the middle of the process. We can say that practically only a miracle will be able to save Dilma Rousseff from losing her job. That's already easy, given the state of the financial market.
Well, let's quickly look at what's happening in Europe as markets are eyeing Janet Yellen's speech for clue on rate hike. Let's talk to Javier Aguedes, DWTV Channels TV financial correspondent out there. Good afternoon, Javier. Now, it's the D-Day for U.S. Fed Chair to make her speech. How is the market awaiting that speech?
Well, the market is, of course, very anxious to hear what Janet Yellen is going to say. At the beginning of the week, we saw a lot of volatility because people were expecting to see, with a certain degree of cluelessness, if you want, what we would hear. We all know that the Fed wants to have an interest rate hike in the United States anytime soon, but we don't know whether it's going to be 1 or 2 this year and how large it would be in any case. As we saw the latest results of the U.S. economy, which came in pretty solid, I'm talking about the jobless claims and also the industry production in the United States, we all assumed then that we will probably hear that this interest rate hike is going to happen in the very near future. But the very latest that we've heard, before the Fed, or for that matter, Janet Yellen speaks, it's all about what some voices of the Fed say before and after. And the very latest statement that we've seen from James Bullard, he is the president of the Federal Reserve of St. Louis, is that he does not see the necessity of more than 1 interest rate hike in the next 12 months, and that he also criticizes the way the Fed has been handling these interest rate hikes, keeping the markets on hold and making a big secret out of the decisions that are being made. We see a lot of tension every now and then, and everyone is expecting to see what the Fed is going to say. Now, will that change how the Fed operates? Probably not, but until then, we all keep our eyes wide open and our ears, of course, paying a close attention to the words.
Yeah, sure, Javier. We just have to keep our eyes open. But then an interesting data coming out from Germany.
All right, it seems like I lost the line, so
Yeah, an interesting data coming out from Germany from market research group JFK indicates that German consumers are willing to increase spending. In other words, the UK's pro-Brexit vote and recent terror attacks in Bavaria, Germany have not been able to dampen their spending spirits. Is that piece of information an excitement for shareholders and the market as a whole? Oh, we seem to have lost Javier there. We'll take a quick break now, and when we come back, the program continues. Do stay with us.